Dividend investing for beginners. How the rich earn while they sleep. Have you ever wondered how the rich keep getting richer even while they sleep? The secret often lies in dividend investing. Instead of just watching stock prices rise and fall, dividend investors focus on companies that pay out part of their profits regularly, providing steady income on top of potential growth. In this video, we'll break down the basics of dividend investing, why it's one of the most powerful wealth-building strategies, and how beginners like you can get started today. So before we start, make sure to hit the like button and subscribe to my channel. 1. What is dividend investing? Dividend investing is a strategy where investors purchase stocks in companies that regularly share a portion of their profits with shareholders in the form of dividends. Unlike growth stocks that reinvest all earnings back into the business, dividend-paying companies typically have stable revenues, consistent profits, and a long track record of rewarding investors. For beginners, this type of investing can feel like getting paid just for owning a piece of a company. For example, if you hold shares in a company that pays a 4% annual dividend, you will receive payouts based on that yield, whether monthly, quarterly, or yearly, without having to sell your stock. This is often compared to rental income, but without the hassle of being a landlord. The true power of dividends lies not just in receiving income, but in reinvesting those payouts to buy more shares, which then produce even more dividends, a snowball effect known as compounding. Dividend investing is popular among retirees, but it's also a long-term wealth-building strategy used by the wealthy, who essentially earn money around the clock. The appeal is clear. While stock prices fluctuate, dividends provide a steady cash flow that can supplement income, cover living expenses, or be reinvested for faster growth. Understanding this foundation is the first step in building a portfolio that generates passive income over time. 2. Why the wealthy love dividend income. The rich have long relied on dividend investing as a way to grow and preserve wealth. Unlike wage income, which requires continuous work, dividend payments roll in automatically, allowing investors to live off their investments. This is often referred to as earning while you sleep. For wealthy investors, the key benefit is stability. Dividend-paying companies tend to be established businesses with strong financial health, such as those in utilities, consumer goods, or banking. These businesses often continue paying dividends even during economic downturns, providing consistent income when other investments may be underperforming. Furthermore, dividends offer a form of diversification within the stock market. Rather than relying solely on capital appreciation, investors enjoy both potential price growth and guaranteed payouts. Tax treatment is another major reason the rich prefer dividend income. In many countries, qualified dividends are taxed at lower rates than regular income, allowing wealthy individuals to retain more of their profits. On top of that, reinvested dividends create a compounding effect where wealth grows exponentially over time without any additional effort. This explains why billionaires like Warren Buffett favor dividend-paying companies. 3. How dividends work. Dividends are typically paid out of a company's profits. When a business generates surplus earnings beyond what it needs for operations and growth, management may choose to distribute a portion to shareholders. These payments are declared by the board of directors and can come in different forms, though most often they are cash deposits directly into an investor's brokerage account. Companies usually pay dividends on a quarterly basis, though some pay monthly or annually. The amount paid per share is known as the dividend per share. To measure dividend returns, investors often look at the dividend yield, which is the annual dividend divided by the current stock price. For example, if a stock trades at $100 and pays $4 per year in dividends, its yield is 4%. This allows investors to compare dividend-paying companies more effectively. Not all companies pay dividends. Many high-growth firms reinvest their profits instead, but mature, stable businesses often do. Another important concept is the payout ratio, which shows the percentage of earnings a company returns to shareholders. A lower payout ratio suggests sustainability, while an overly high ratio may be risky if earnings decline. 4. Benefits of dividend investing. Dividend investing offers numerous benefits, making it particularly attractive to beginners and long-term investors. First, it provides a steady stream of passive income. Unlike other investment strategies that rely solely on market appreciation, dividend stocks allow you to receive cash without selling your shares. This makes them ideal for building an income source for retirement or financial independence. Second, dividend investing reduces risk during market downturns. Even if stock prices fall, dividend payments can continue, cushioning losses and offering psychological reassurance. Third, dividends can fuel compounding growth. By reinvesting dividends to buy more shares, investors harness the power of exponential growth over time. A portfolio that consistently reinvests dividends can snowball into a massive income-generating machine. Fourth, dividend-paying companies tend to be financially stable, with predictable earnings and strong management. Investing in such companies lowers the risk compared to speculative growth stocks. Fifth, dividends can act as an inflation hedge. As prices rise, many companies increase their dividends to match inflation, helping investors maintain purchasing power. Finally, dividend investing aligns well with long-term wealth strategies. 5. Key metrics to analyze dividend stocks. Before investing in dividend stocks, beginners should learn to evaluate key financial metrics. The most common is the dividend yield, which shows the annual dividend relative to stock price. However, a very high yield can sometimes signal trouble, as it may indicate the market expects the dividend to be cut. Equally important is the payout ratio, which tells you how much of a company's earnings are being paid out in dividends. A sustainable payout ratio is usually below 60%, although this varies by industry. Investors should also consider the company's dividend growth history. Firms that consistently increase dividends every year demonstrate financial stability and shareholder commitment. These are often called dividend aristocrats or dividend kings. Another critical factor is the earnings growth rate, since strong and growing profits support future dividend increases. Additionally, balance sheet strength matters. Companies with high levels of debt may struggle to maintain dividends during downturns. Beginners should also examine the free cash flow of a company, which measures the actual cash available for dividends after expenses and investments. Relying on net income alone can be misleading, so free cash flow is often a better gauge of dividend safety. 6. Best strategies for beginners. For beginners, the best approach to dividend investing is to start simple, stay consistent, and focus on quality. One popular strategy is the buy and hold approach, where you invest in dividend-paying companies and hold them for the long term, reinvesting dividends to accelerate growth. Another option is investing in dividend aristocrats, companies with a track record of increasing dividends for 25 consecutive years or more. These stocks provide both reliability and growth potential. Beginners may also consider dividend exchange-traded funds, which pool together dozens or hundreds of dividend-paying stocks, reducing the risk of relying on just one company. Exchange-traded funds are an easy way to gain exposure without deep research. A helpful tactic is to build a diversified dividend portfolio across different industries, such as utilities, technology, healthcare, and consumer staples, to spread risk. Dollar cost averaging, where you invest a fixed amount at regular intervals, ensures consistency and protects against market volatility. Another key strategy is focusing on dividend growth investing rather than chasing high yields. Now, if you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.